You saw it happen in real time. Silver didn't just move up this week. It ripped through the $90 zone, then whipped so hard intraday that anyone watching the screen felt their stomach drop. And the wild part is, that violent dip wasn't the end of the move. If you're here because you're asking one question, is silver about to go even higher, or is this the top? Then stay with me, because the next price level being discussed is not $95, not $100. It's $106. And when the market starts whispering a number like that, the next thing that usually shows up is FOMO. Now, quick reality check before we go any further. I'm running a campaign to push copycat channels out of the space. If you value original work, hit subscribe and comment OG John AG so the algorithm knows who you're backing. All right, let's get into exactly what happened, why the $106 level matters, what could go wrong after that, and what the charts are quietly suggesting for gold, platinum, and even the stock market. Because silver isn't moving in a vacuum. And in a minute, I'll show you the one behavior that separates a rally from a final blow off top. It's moving in a world where money is nervous, headlines are loud, and the crowd is getting emotional. And emotions are where fortunes get made and where people get wrecked. So here's the story. Silver's price action has been building pressure for a long time, and then 2025 lit the fuse. Momentum came in hard, volume picked up, and suddenly silver stopped being that metal people talk about and started becoming something people actually chase. You see it everywhere. People who never cared about metals are suddenly asking where to buy. People who used to mock it are suddenly saying, wait, did I miss it? And that is exactly the environment where charts become dangerous and powerful at the same time. Because the chart doesn't care about your feelings. It doesn't care about your politics. It doesn't care about your favorite influencer. It cares about one thing, price. And when price accelerates, certain technical tools tend to repeat more often than people want to admit. One of those tools is the Fibonacci extension. Now, I know some of you roll your eyes when you hear that word, but here's why I still pay attention. It's not magic. It's not astrology. It's a way of measuring how markets often expand after a strong impulse move, and where they tend to meet resistance when the crowd gets greedy. So let's break down the map that traders are using right now. Silver made a surge, peaked hard, then pulled back into a clear low. When you measure that run and project the extension, two zones show up like signposts on the highway. The first one is the 61.8% extension, the so-called golden ratio. That level often acts like a speed bump. Price hits it, gets volatile, shakes people out, and then decides whether it has enough fuel to keep going. And what did we just see? We saw a sharp push into that zone. Then we saw a nasty drop, a gap down. And then we saw buyers step back in and drive it right back up again. That's not bearish behavior. That's the market testing weak hands and finding out who actually wants to own silver. And when a market can do that, drop hard, scare everyone, and then recover, what it's often doing is preparing for the next leg. Which brings us to the second signpost, the 100% measured move, the full extension, the level that a lot of people are now staring at like it's a finish line. That number is roughly $106.25. And from where silver has been trading, that's around a mid-teens percentage move. In normal markets, that's a big deal. In silver, that can happen faster than you think. You've already seen days where the range from high to low inside a single session felt insane. We've had sessions where the swing was around 15%. 15% in a day. That's not a calm uptrend. That's a stallion. That's a market that can make you money quickly and can punish you quickly. And there's a reason those swings have been showing up more frequently. As price rises, exchanges tend to raise margin requirements. They do it to protect themselves. They do it to reduce systemic risk. But the practical effect is simple. Leverage gets forced out. People who were riding the move on borrowed money get hit with higher requirements. They get margin called. They sell. And that selling creates those ugly, sudden drops that make you think the rally is over, until it isn't. Now here's the part that gets interesting. A lot of people are currently selling into strength. Dealers are seeing more profit taking. Not because everyone is bearish, but because people are finally sitting on gains they never thought they'd see. And when something runs this fast, portfolios get distorted. If you owned a bunch of silver, you might wake up and realize your balanced portfolio is now mostly silver. So people trim, they rebalance, they lock in profits. That's rational. But it creates a weird psychological trap for the market, because the people who sell early often get pulled back in later. And that's where the $106 target becomes more than a number. It becomes an emotional trigger. Think about the psychology. You sold at $90 because you thought you were smart. Then silver hits $97. You feel a little uncomfortable. Then it hits $102. Now you're annoyed. Then it tags $106. And suddenly you're not thinking logically. You're thinking, I have to get back in. That is classic FOMO behavior. And when FOMO shows up near a major measured target, it often marks a turning point. Not always a crash. Sometimes it's just a pause, a long, frustrating consolidation where price chops sideways and destroys impatient people. But either way, it's usually a moment that matters. So if you're asking me what the short-term next big number is, that's the one, around $106. Now, before you comment, so you're saying it's guaranteed, let me be crystal clear. Nothing is guaranteed. Markets don't owe you anything. This is not financial advice. This is analysis, probabilities, and risk management. And that's exactly why the next question is more important than the target. The question is, what happens after $106? Because that's where people get complacent. They hit a target, they start dreaming about $200, they stop managing risk, and then the market reminds them what silver does. So let's talk about the two possible stories after $106. Story number one, consolidation before another push. This is the pause, then higher scenario. Silver tags the target, cools off, builds a base, and then later makes a move toward the next zone, maybe 120, 125, or more. In that world, $106 isn't the end. It's an intermission. Story number two, topping behavior. This is the peak then give back scenario. Silver tags the target, forms a topping pattern, breaks down, and then starts bleeding lower. Not because silver is dead, but because parabolic moves often have brutal mean reversion. And the truth is, silver has a history. In big spikes, think 1980, think 2011, silver didn't gently pull back 10% and then go higher. It collapsed. We're talking 50%, 60%, even 70% drawdowns from the high. That's not a scare tactic. That's history. So if silver were to hit roughly $106 and then pull back in that same kind of percentage range, where would it land? It could land right back near the big breakout zone that kicked this whole new era off, around the mid-40s. That's not a prediction. That's math. A 50% pullback from $106 is about $53. A 60% pullback is about $42. So when people talk about a normal big correction, that's the territory. And that's why I keep repeating, you need an exit plan. Not because I'm bearish, not because I think silver is doomed, but because time is money. If you ride a parabolic move all the way up, then all the way down, and then spend years waiting to get back to even, you paid for that lesson with your time. And most people don't factor time into their strategy. They only think in dollars. Now, here's a practical way to think about it without panic. You don't have to sell everything. You don't have to become an all-in trader. But trimming into strength, rebalancing, and paying attention to the chart structure after a major target gets hit, that's not weakness. That's how you survive. Because you can always buy an asset again. If silver pulls back and then proves it wants to run again, you can re-enter. The only thing you can't buy back is wasted time. Now, while everyone is hypnotized by silver, there's a second metal quietly doing its job, gold. And gold is the boring metal, which is exactly why it's so dangerous. Because boring assets tend to be where big money hides. Gold doesn't usually swing 15% in a day. Gold moves slower. It's steadier. It tends to be the global fear gauge. So when I see gold setting up for another push, I take it seriously. Using the same kind of measured move thinking, traders are watching a zone in the low 5,000s, roughly $5,170 to $5,200 as a potential target. That's about a low teens % move from recent levels. Not flashy like silver, but in gold terms, that's meaningful. And here's what many people miss. Gold can also correct hard when the world flips from buying to selling. In a major risk-off event, gold can still drop 25 to 35% in a sharp correction. Not because it's worthless, but because when leverage unwinds, it hits everything. So again, it comes back to the same principle. Trend first and plan second. Now, let's talk about the third metal that keeps surprising people, platinum. Platinum had a big move. It doubled last year. And when you measure the recent swing and project forward, there's a target zone that pops up around the mid $3,600 area. Call it roughly $3,600 to $3,660. That's a chunky percentage upside from where it has been. And it's the kind of move that can happen in a metals together environment, like we saw in 2007-2008, when multiple metals surged in sync. Now, I'm not saying every metal is equally clean right now. Some charts look choppier. Some suffered more damage in previous sell-offs. But if you're asking what the rank order looks like in terms of cleanest trend and tradability, a lot of active traders still put gold at number 1, silver at number 2 for upside, but with higher danger. Platinum is a strong third if it confirms. And the point of saying that isn't to tell you what to buy. It's to remind you that the metal space is a rotating game. Capital moves. It chases momentum. And when one metal gets too hot, money often spills into the others. Now, I want to pause and ask you something, because this part matters more than any target. What would you do if silver hits $106 and then drops 20% in a week? Would you panic? Would you hold? Would you buy more? Drop your honest answer in the comments, because your reaction tells me what kind of market participant you are. And here's the second question. If you could only hold one metal for the next year, gold or silver, what would you choose and why? Now, in the middle of all this, I also want to do something different. If you're the type of person who loves hearing how regular people actually made it in this metals game, especially silver, there's a separate channel linked in the description where we collect silver-related success stories. If you want that motivation and those real examples, go subscribe over there too and binge a few. It will change how you think about patience and timing. All right, back to the main thread. Because metals don't exist alone. They live inside a broader market ecosystem. And right now, that ecosystem is strange. Stocks are still pushing. Equities are still in a bullish posture. But they also feel frothy. You can feel the tension. It's the kind of market where everyone is confident until the first real crack shows. On the longer chart, the stock market has had a correction, then a pause. Then it looks like it still wants to grind higher. Short term, there may still be room for a few more percentage points to the upside. Maybe 3%, 4%, maybe more. And you can see that on shorter time frames, where dips into oversold zones often get bought by institutions. That's why people keep getting punished trying to short too early, because even a market that looks tired can keep walking higher. But here's the cliffhanger. When the economy and the stock market finally peak, and when the crowd flips from net buyers of everything to net sellers, there is often no perfect safe haven. You can see stocks fall. You can see metals fall. You can see crypto fall. And the only thing that feels safe is cash. Sometimes even the US dollar index rises during those moments. Not because the dollar is great, but because global stress makes people scramble for liquidity. And that's why I keep coming back to a simple framework. Be with the trend. Own what's in an uptrend. Trim when it gets too hot. And be willing to step aside if the chart breaks. Because stepping aside isn't quitting, it's resetting. And speaking of staying connected, if you want daily videos, quick updates, posts, and my personal analysis beyond what YouTube allows, I created a WhatsApp channel and a community where I drop premium updates I don't post publicly. Instant voice notes, rapid breakdowns, and alerts when something changes fast. The link is in the description. Join it now so you're not reacting late. Now, I'm going to tell you a truth that most analysis channels avoid saying out loud. Nobody knows the future. Not me. Not the biggest bank. Not the loudest guy on TV. The only thing we can do is follow price. Price is the scoreboard. And the most consistent traders I've ever studied don't obsess over headlines. They obsess over structure. They follow trend criteria. They set targets. They manage allocations. They treat investing like a process, not a personality. That's why I always warn you about crowded trades. When an asset goes straight up, it means everyone is already leaning the same way. They don't want to sell because they love it. So the price keeps lifting because the only way to get it is to pay more. That's how parabolas are born. And parabolas are where you make the easiest money, right before you find out how hard it is to keep it. So if silver is the wild stallion, gold is the steady horse. And right now, both are running. Which brings us to the most practical part of this entire video. What do you actually do with this information? Here's my approach in plain English. If silver is running toward $106, I'm not sitting here trying to call the top today. I'm watching how it behaves as it approaches major resistance. I'm watching whether it gets there in a clean climb or a manic spike. I'm watching volume. I'm watching volatility. And I'm watching for the pattern that forms after the level is hit. Because the post-target behavior tells you more than the target itself. If it hits $106 and starts chopping sideways, but holding higher lows, that's a constructive pause. If it hits $106 and then starts breaking support levels with heavy selling, that's a warning. And if you've never studied what topping patterns look like, this is where you start. Because the market won't announce the top. It will whisper it. And the whisper is in the structure. Now, I can already hear people saying, but I'm a long-term holder. Good. Then your job is even simpler. Your job is to make sure you don't sabotage yourself emotionally. You don't have to trade every wiggle, but you do have to understand what drawdowns feel like so you don't panic at the worst moment. Because a 20% pullback in silver is normal. A 40% pullback is painful. A 60% pullback is where the weak hands swear off metals forever. And that's why the people who win are usually the people who plan for the pain before it arrived. Now, before I go deeper, there's one more thing I need to say, and I'll keep it short. By the time you're watching this, a members-only video is already published with a single, clean timeline of the updates so far, plus the extra in-depth analysis I don't always put on the public feed. If you want that one video that ties everything together and shows me you're really following, join the membership and watch it, because that's where we go deeper than headlines. All right, now let's go deeper into the why behind the move, because yes, charts matter, but psychology matters more, and silver right now is turning into a mainstream conversation. When you see regular buyers picking it up in everyday places, that's not just demand, that's narrative. And narratives are rocket fuel. They can take an asset further than fundamentals justify in the short run. But they can also reverse fast when the story changes. Which is why I keep stressing, targets are not destiny. Targets are checkpoints. Now, one thing that might surprise you is that increased selling can actually be bullish in the short term. It sounds backward, but think about it. If people are taking profits along the way, it prevents the market from becoming too one-sided too quickly. It creates dips. Dips create entries. Entries create new holders, and new holders create the next wave. So when you hear more people are selling, that doesn't automatically mean the top is in. Sometimes it means the market is digesting gains and building the next base. But again, the difference is in how price behaves after key levels. Now, let's talk about the concept of rebalancing. A lot of the smartest investors in the world aren't emotional, they're mechanical. They allocate, they rebalance. If an asset explodes, it becomes too large a share of the portfolio, so they trim. They're not bearish, they're disciplined. And that discipline is what keeps them alive across cycles. So if you're sitting on big silver gains, it is normal to think about trimming a portion near major targets. Not because you hate silver, but because you respect it. You respect what it can do on the way down, and you respect your own psychology. Now, I also want to talk about a trap that shows up in every bull run. It's the trap of, I'll sell at the top. Everyone says it. Almost nobody does it. Because when price is rising, you feel smart for holding. So you hold longer, and then longer. And then you hold until the move is over. And then you tell yourself you're a long-term investor while you watch profits evaporate. If that's you, I'm not judging you. I'm telling you there's a better way. The better way is to sell in pieces, to trim into strength, to let the market pay you, and to keep a core position if you believe in the long-term story. That way, you don't have to be a hero. You just have to be consistent. Now, let's pivot back to gold for a moment, because gold is doing something important. Gold is showing that fear is still in the system. Gold and stocks rising together can happen. It often happens in liquidity-driven environments. But when the real unwind hits, correlations can spike, and everything can drop together. That's why some traders say the best asset in a crash is simply the one you already have profits in, plus a plan. Cash is not exciting, but cash is optionality, and optionality is power when other people are forced to sell. Now, I'm going to open a loop here, because this is where a lot of people get blindsided. If silver hits $106 and then pauses for months, the internet will get bored. The hype will fade, views will drop, people will move on. And that quiet period is when the next big opportunity is often being built. Because the crowd hates boredom. The crowd loves action. So the crowd shows up late, during the action, and leaves early, during the base building. But the base is where the big move starts. So if we do get a multi-month consolidation after 106, that may not be the end. It may be the setup for the next phase. And the only way you'll know is by watching structure. Now, I want to tell you how I think about proof. I don't need to predict. I need confirmation. If price is in an uptrend, I respect it. If price breaks and forms a bearish pattern, I step aside. If price builds a new base and breaks out again, I re-enter. That's it. It's simple. It's not easy, but it's simple. And this approach is why some traders don't mind buying back at a higher price, because they're not trying to get the perfect entry. They're trying to catch the bulk of the move with less stress. Now, some of you are thinking, okay, John, but what about other sectors? Fair, because if metals pause, where does the money go? In many cycles, money rotates back into equities until the next shock arrives. And right now, equities still look like they have momentum. But that momentum is fragile. It's the kind of momentum that can vanish when a big player hits the sell button. And when that happens, everyone suddenly pretends they saw it coming. So here's what I'm watching in equities. I'm watching for a final push higher. I'm watching for a blow-off behavior. I'm watching for a failure to make new highs. And I'm watching for the kind of selling that doesn't bounce. Because right now, dips are still getting bought. And as long as dips get bought, the trend is intact. But when dips stop getting bought, that's when you shift from buy the dip to protect the bag. Now, one more engagement reminder, and then I'll keep rolling. If you're someone who has already made money in silver, gold, stocks, crypto, whatever, share your success story in the comments. Seriously, even if it's small. Someone reading might need that push, and it keeps the whole community's morale high. Now, I also want to address the "what if I missed it" crowd, because I know you're here, and I'm not going to roast you. Missing a move happens. The question is what you do next. If you chase late, you become exit liquidity. If you wait for a plan, you become a participant. So if silver runs to $106, the worst thing you can do is buy because you're emotional. The best thing you can do is study the structure, wait for a pullback or a base, and then enter with a plan. Now, that doesn't mean price has to gift you a perfect dip. Markets are not polite. But it does mean you should never enter a position without knowing where you're wrong. If you don't know where you're wrong, you don't have a trade. You have hope. And hope is not a strategy. Now let me tighten the recap of the key points so far because I want you to have the whole picture. Silver broke above $90 and showed extreme momentum. A Fibonacci extension map shows the golden ratio zone was tested, volatility hit, and buyers defended. The next major measured move target is around $106.25. That target can act like a magnet because it becomes an emotional milestone. After that, silver often pauses, and the pause can be either bullish consolidation or topping behavior. History shows parabolic silver moves can correct 50 to 70%. A big correction from $106 could bring price back toward the mid-40s. Gold has its own target zone in the low 5,000s and tends to be steadier, but can still correct 25 to 35% in a crisis. Platinum shows a potential target zone in the mid-3600s if it confirms. Equities are still bullish but feel frothy. A final push is possible, and then a sharper sell-off could arrive. Cash can outperform in chaos simply because it offers optionality. Now, here's the cliffhanger I promised. The most dangerous moment in a bull run is not the dip. It's the moment right after a new target gets hit. Because that's where the crowd thinks, now it's safe. That's where people leverage up. That's where late buyers chase. That's where the market has the most fuel to punish. So if you want to survive what's coming, your job is to watch what happens at the target, not just cheer that it got there. And to make that practical, here are the 3 signals I'd watch right after $106. Signal 1. Does price hold above the last major support level during pullbacks? If pullbacks are shallow and buyers keep stepping in higher, that's strength. Signal 2. Does volume spike on the move up and then fade on the pullback? That often suggests sellers aren't in control. Signal 3. What kind of pattern forms? A tight range with higher lows can be bullish. A broad, choppy range with failed bounces can be distribution. Now, none of this requires you to be a chart wizard. It just requires you to be honest about what you see. And honesty is rare in markets. Now, I want to deal with one more narrative that floats around every time silver gets hot. People start talking like, this time is different. Sometimes it is. Sometimes new demand and new monetary conditions create a new regime. But even in new regimes, corrections still happen. And the corrections are what separate tourists from participants. Tourists arrive for the party. Participants stay for the boring work. Now, here's a small tactic that helps with psychology. If you're holding physical metal and you're terrified of volatility, separate your mindset. Physical is a long-term store. Paper trades are tactical. If you mix those 2 mental buckets, you'll make emotional decisions. Now, I'm going to say something that might sound simple, but it's powerful. If you own an asset because you believe in the thesis, you don't sell because of a one-day swing. But if you own an asset because it's trending, you don't ignore a broken trend. Different reasons, different rules. And most people lose because they don't know why they're in the position in the first place. Now let's talk about the squeeze energy that everyone loves to scream about. Yes, tight markets can create bursts. Yes, mainstream attention can create rushes. But squeezes are messy. They're not straight lines. They're whipsaws. And those whipsaws are designed to shake you out. That's why margin requirement changes matter so much. They force out weak leverage. And when weak leverage gets forced out, price can actually become healthier, because then it's being held by real buyers, not borrowed money. Now at this stage, some of you are thinking, so what's the next move? And here's my honest answer. The next move is to watch the behavior, not to worship a number, not to panic over a candle. Watch behavior, because behavior tells you if the move is being sustained by demand or being faked by emotion. Now I'm going to talk to 2 groups of people for a second. Group 1, the people who have been waiting years for silver to finally move. You deserve your moment, but don't let that emotional relief turn into recklessness. Celebrate, but stay sharp. Group 2, the people who didn't believe and are now feeling the regret. Regret is expensive if you act on it. Use regret as fuel to build a plan, not as a reason to chase. Now remember earlier I mentioned the crowd getting pulled back in? That's why $106 matters, because it's not just a target on a chart, it's a narrative level. It's the kind of level that triggers headlines like, silver breaks new record, and those headlines attract late money. And late money is what often completes a move. But late money is also what gets trapped. So if we do see a spike into $106 with the loudest headlines you've ever seen, that will be a moment to breathe, not a moment to YOLO. Now, one last layer. When multiple metals move together, it often signals broader monetary stress and broader commodity repricing. If gold is pushing, silver is pushing, platinum is pushing, that can mean the market is sniffing out something bigger. Not a single news story, a broader shift. And if that's the environment we're in, then the next months could stay volatile. Which brings me back to what I said at the beginning. Silver is not moving in a vacuum. It's moving in a world where investors are searching for certainty. And the only certainty markets give you is change. Now, I want to make sure you didn't miss the action steps that matter. Subscribe if you haven't, because the next phase will move fast, and I don't want you catching the recap after the opportunity is gone. Join the WhatsApp channel in the description if you want instant updates and voice notes. Check the members-only video that's already live if you want the full timeline and deeper analysis in one place. Now, here's my final thought, and I want you to really sit with it. The market doesn't pay you for being right. It pays you for managing risk while you're right. Silver may hit $106. Silver may overshoot it. Silver may pause. Silver may pull back hard. But none of those outcomes have to break you if you have a plan. So tell me in the comments, are you riding this move all the way? Are you trimming into $100 plus? Or are you waiting for a pullback? And if you've got a win in your life right now, silver related or not, share it down there too. I read those. They matter. And they remind people that progress is possible. All right, I'm John A.G. Take care of yourself, take care of your people, and I'll see you in the next one.